So the last thing that we are going to do under this is the abandonment decision. Abandonment decision, this is financial management. Abandonment decision. Abandonment decision. So class, there come a time when when we abandon available assets, when we abandon the available assets or items, available asset or items, due to several, sometimes you may find that those items are not meeting the required objective or the required goal. Therefore, we tend to abandon them before their useful life, end, or before the end of their useful life. So we say that it is proper to abandon those items when their net present value is high. So we abandon them when at least we can get something from them. So we're going to look at some of the reasons for abandonment. We're going to look at an illustration that will guide us on how this abandonment is done and the decision, where the decision is made. So I think, class, we can say that abandonment may occur. Abandonment may occur in case the company have an asset. In case the company have an asset, yet it is productive. But it will be costly in long run. Yes. There is an asset in the company, yet it is productive, but it will be costly in long run. Here we are having an asset. Yes, it is productive, but it will be costly in long run. It will be costly in long run. Will be costly in long run. So the reason for abandonment is because we are incurring more cost on these assets, or abnormal cost on this asset than usual, and that's why the abandonment decision comes in. Maybe the maintenance cost of that item is so high, When you compare that with the returns, we find that it is more expensive having that. It's more expensive having that item. The asset reaches its salvage value. The asset is disposed before it reaches its salvage value. So we sell this asset or the machine before it reaches value. Transpose is where the NPV is high. So at this, we shall be revolving around the NPV. The NPV shall be revolving around the NPV. Class, let's look at the factors that may lead to abandonment decision. Factors that may lead to abandonment decision. Factors factors that may lead to abandonment decision. A question. Okay. I've seen a comment here. Allow me to see this comment. Seen a comment here. Second point. Okay. Sound is breaking. What might be the problem? Okay. Kulikuwa na hitches on my side. Okay. Let me try to see what is Well, Peter, where are we? Peter, tuko wapi? Peter, can you state where we are? Point two was talking about what? It is disposed before it reaches its salvage value. It is disposed before it reaches its salvage value. It is disposed before it reaches its salvage value. Hapo sasa tuko sawa. So what do I dispose? The item, the asset. You're talking of Peter, the asset. You're talking of the asset. The asset. Sawa. Let's look at the factor that may lead to abandonment decision. Factors that may lead to abandonment decision. So, class, these are factors that you can state. These are factors that you can state. For example, technological changes. That's a factor. Technological changes. Can you give me some of these factors? It reaches. Asante. Maintenance cost. Yeah. Those points you can have them just application hapa. So technological changes. Sasa kama zile kompyuta kubwa za kitambo, siku hizi hakuna due to these technological changes. Hata ofisi iko na zile kompyuta kubwa. Tena TV zile ilikuwa ile ya mgongo, ile iko na mgongo kubwa. Ukikutana na mtu ako na hiyo TV ya mgongo, unaona kwa nyuma sana sababu due to technology mambo inabadilika. Maintenance cost ikuwa maintenance cost. Ingine, another factor that you think abandonment value. Ukiangalia value yenye tunahitaji, the abandonment value. What's wrong with Peter? Peter, what are you saying? I'd like to know what you're saying. Peter, I'd like to know what you mean. Sometimes we tend not to understand. Say. To see. Then we have opportunity cost. opportunity cost, and those are some of the factors. You can add other. Hai, point hata umepewa hapo. Point hata watu wame screenshot, wengine wame Peter jameni. Peter jameni. Peter jameni. There's a point umepewa hapo Just look at the chart. Look at those charts. The point iko kwa chart. Already in the chart. Na tumeirudia mara mingi. Uzuri is that we are having the video. We are having the video. Uzuri, we are having the video. Great. So class, let's look at May 2019, question number 5. Let's look at May 2019, question number 5. So somebody to share with us the question. 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 It's talking of May 2019. May 2019. Question number 5C. So somebody can share that. May 2019, question number 5. Okay, thank you so much, Mbone. Thank you so much, Mbone. So here we are. Let's look at question number 5 and try to see how the NPV can help us determine the abandonment time. The abandonment time. At what time should we abandon? And I'd like you to note that here we are dealing with this item. Even if the useful life is 5 years, we are dealing with the same item. So we need to look at the net present value at every section or at every step, every year. We look at its net present value so that we know at which year shall we abandon that asset. Shall we abandon that asset? So let's see. May 2019. Is this May 2019? Okay. Question number 5. Yes, 5C. Let's look at question number 5C. So I hope we are there. I hope we are there. Question number 5C. So allow me to read the question. So we are told that Parakumi Agribusiness Limited is analyzing a youth empowerment project. The following information is provided. The following information is provided. So to corner, here we have cash flow, we have abandonment value. That is sharing in million. Year 0, 1 to 4. The initial outlay is 16, and then we have the cash flow of 8, 6, 5, and 4 million, and then the abandonment value for year 1 to 3 is 12, 8, and 6. Year 4, we don't have abandonment value. Therefore, we shall be looking at the present value and then subtracting our initial outlay to get the what? The NPV. So class, allow us to solve this question. Using the NPV. The company cost of capital is 10%, and we are told to advise the Parakumi Agricultural Limited on the optimal time to abandon the project. Which will be the best time to abandon the project? This is May 2019. May 2019. This is question number 5C. May 2019, question number 5C. So we are looking at this question step by step. So we start with the year one. So how do we get the NPV class? NPV, we get it through the total present value, of course, discounted cash flow minus initial outlay. Now, how do I get the total present value or the total cash inflow? Total cash inflow. Total cash inflow minus initial what? Initial outlay. Total cash inflow minus initial outlay. Total cash inflow minus initial outlay. Now, class, at this point, you find that we need to get the present value of cash flow as well as the present value of the terminal cash flow. And what is our terminal cash flow here, class? What is our terminal cash flow? The abandonment value. The abandonment value. When they have suggested that the abandonment will take place. So the abandonment value will be termed as the terminal cash flow. As the terminal cash flow. So we can start with the first year. So the first year we are having 8 as the cash flow. We discount that using the PV. Of course, these are irregular cash flows. Therefore, we are discounting using what? Using the irregular or the PV, irregular factor. So let's do -1. That one is for the cash flow plus that of or terminal cash flow. Terminal cash flow is 12 times 1.15 raised to -1. Now that is for year 1 inflow. Can you give me the total year 1 inflow? That is the cash inflow for year 1. Ningapi? If you add the two, cash inflow for year 1, how much shall you get or shall we get? How much shall we get? Gapi? How much? No. The cost of capital is 10%. Did I use 15 here? Oh, it is 1.1. 1.1. Oh, 1.1. You see the total obsolescence. Yeah, obsolescence. Your point ndio imefika. Yeah, cost of capital is 10%. Asanteni. Obsolescence. Yeah. Nipatie hii. Cost of capital is 10. So how much shall we get as the total inflows? Total cash inflows. Nipate hii faster. 18.182. So 18.182. That is very good. And then if I want to get the NPV, nimesema kwamba ni total cash inflow, which is this minus my initial outlay. Remember the initial outlay. We're dealing with this one project. So initial outlay will remain the same throughout. Abaki ngapi? 2.182. 2.182. So our net present value at year 1, if we abandon that at year 1, tutapata hii. This is what we shall get. If we abandon that at year 1, that is what we shall get. This is year 1. What about now when we go to year 2? Year 2. Class, I want you to note that in year 2, this cash inflow will also be included. It will be part of the inflows. It will be part of the inflows. Therefore, we shall be having this one, the 8. Or let me just arrange it the other way so that it does not confuse you. Year 1 must be included because this is the same project. The only thing that is changing is our abandonment value. So year 1 and 2, the cash flow here I have 8, and year 2 niko na cash flow ya ni 6 ama. Year 2 I have the cash flow of 6. 6. Thank you. And then I have to discount using PV 10%. And I know for this one, there's no problem. It is 0 point something. Give me the discount factor here. 1.1 raised to -1. Hiyo haina maneno. It will remain the same. Whatever that you would get here, it will remain the same. Only that I want to arrange it like that so that I get my discounted cash flow hapa. 1991. Then we get this of the second year. The second year ni ngapi? Second year itakuwa ngapi? Second year class, how much shall we get? 8264. Now, can you multiply 8 times this tuweze kupata value yake, and then 6 times this tupate value yake, so that we get the total discounted cash flow for that. For the first one, for the first year tunapata ngapi? 7.2727. 7.2727. Haya, ya pili, the second one. Let's get the second one. 7.27. Okay. Ya pili still. The second one, 4.95. 4.9584. 4.9584. So when you add the two, what shall you get? Tapata ngapi? What shall we get? When you add the two, what shall we get? Ukiongeza hizo mbili, tunapata nini? Add the two. Please add the two. We see what we shall get when we add the two. 12.2311. 12.2311. Plus, that is the inflow. That is the inflow for the cash flow. Then we add that of the abandonment value. Here, abandonment value in year 2. Abandonment value in year 2 is 8%. So 8. It is 8 times 1.1 raised to -1 or -2 class. -1 or -2. We are abandoning in the second year. Therefore, -2. Yes, we are abandoning in the second year. So itakuwa ngapi? This one itakuwa ngapi? Itakuwa ngapi? We are abandoning in year 2. And that is where now the difference is coming in. Itakuwa ngapi? So for year 3, I'll not just even repeat this. Sitashinda nikirudia hizi vitu zote. I'll just pick this. The cash inflow, niongeze ya year 3. 6.612. So when I add all, how much shall I get? How much shall I get? Nikiongeza zote. It is 18 something. Inaingia 18. Ama ni ngapi tena? How much shall we get? No, itavuka kidogo, 18.843. 18.843. Sawa, ina shida. So if I want to get the NPV at that time, is 18.843 minus 16. This will give me 2.843, like that. So class, saying that if I go to year 3, I'll not keep on repeating that. And I know the result for the 2 years. I know the result for the 2 years hapa, so I don't have to repeat. So year 3, it will be the result 12.2311 plus that of year 3. Year 3 cash flow is 5. How is PV for year 2? 0.82. HK ameuliza swali nzuri pale. How is PV? You guys give me that. You guys give me that. You guys give me that. You guys, can you confirm? And HK, I don't know whether you use the table. What did you get from your end? You, HK, what did you get from your end? Remember the formula is 1.1 raised to -2. Ndio tukauliza hivyo. 1.1 raised to -2. So HK, you tell us what you got, and then we compare. 98. HK anapata 98. HK got 98 class. What did you get? Was 8.862, 0.862 correct? Plus we have 8 to equal sawa. So so HK, kindly check whether maybe you if you are using the table, check whether you use a long column. Check whether you use a long column. Kindly check. If you're using a calculator, you just have 1.1 raised to -2. All right, sawa. Now we go to this. We're saying that you just pick these for year 1 and 2. Hatutashida tukiziandika tena. We shall be repeating ourselves. Plus year 3 we have 5 times we discount with 1.1 raised to -3. So tutapata ngapi? What will be the info for that? We can also add our initial the terminal. Year 3 is 6. So it will be plus 6 times 1.1 raised to -3. So whatever that you get when you compute those, you will be giving us what? The total what? The total cash inflow. Cash inflow year 3. So class, how much shall we get when we compute that? Tapata ngapi? How much shall we get? If we compute that, tutapata ngapi? Tutapata ngapi tukicompute, tukihesabu hiyo? Tukihesabu hiyo tutapata ngapi? 20.8712. 20.8712. 20.8712. Then we less, to get the NPV at that point, we less 16. We less 16. So how much do we have? How much do we have now? How much do we have now? Tutakuwa na ngapi pale as our NPV? As our NPV. As our NPV. Raquel alipatia 20. So wacha sasa tupate the NPV itself now. 4.8712. 4.8712. Now I want somebody to confirm the two are these and these. In fact, once you go, everyone is confirming that is okay. Then you go to year 4 class, year 4. So for year 4 class, I don't have to repeat these and also these. I have just to come and add year 4. Year 4 present value. So it is 12.2311 plus 5 times 1.1 raised to -3 plus what year 4 is giving. What is the cash flow? The cash flow for year 4 is 4. So 4 times 1.1 raised to -4. Yes, -4. And then I don't have the abandonment value in year 4. And what does that tell me? That my terminal cash flow is 0, and that will not affect my result. So can you give me the result there? Give me the result so that I get my NPV, net present value. So whatever that you give me at that point is my total cash inflow. Total cash inflow. Total cash inflow. So class, please give me that to be okay. 18.7996. 18.7996. So 18.7996 minus 16. Itakuwa ngapi? 2.7996. Is it? Is that the answer, Mumbi? Hiyo ndio inaingia hapo. All right. Thank you. 7197. So hiyo najua maybe ni differences kidogo. So class, at which year should we abandon this project, or should we advise this company to abandon the project? At what point? At what point should we abandon this project? Yes. or should we advise this company to abandon the project? At which year? Tuangalie vizuri, tuseme mwaka gani? So we just look at the NPV. So this year NPV is 2.7. This year NPV is 4 point something. This year it was 2, and this year it was 2 as well. So at this year, I can see that the NPV is the highest. The NPV is the highest, and as we said that we should abandon when the NPV is high. When the NPV is high, so it is not advisable to abandon at this point. It is not advisable to abandon at this point. It is advisable to abandon at year 3. At year 3. At year 3. So the concept there, class, is just to understand how NPV is done. Just to understand how NPV is done. Once you understand how NPV is done, you are good. You are good. You are good. You are good. So class, let's move on to the next thing. Let's move on to the next thing, which is a great topic, a simple topic, a topic that is repeated in financial what? In financial reporting. In financial reporting. So this concept, you usually learn it twice. You learn this concept twice. The financial analysis and forecasting is our next thing. The financial analysis and forecasting. The financial analysis and forecasting. Financial analysis and forecasting. The financial analysis and forecasting. The financial analysis and forecasting, or analysis of financial statement and forecasting. Great. So the main agenda or the main reason why we analyze the financial statement is to understand the state of the company or the organization, or to know the performance of the organization. That is the main objective of analysis of financial statement. The main objective of analysis of financial statement. And class, as you know, that we have several components of financial statement, namely income statement, balance sheet, statement of cash flow. We also have statement of changes in equity, and we have what? The notes to financial statement. The notes to financial statement. The notes to financial statement. In fact, now under financial management, we shall not go beyond. The statement of financial positions. Just look at the two, the statement, the income statement and the statement of financial position. The cash flow hizo unaziangalia wapi? Kwa financial what? Reporting. Financial reporting. We also have several tools that will assist us in this analysis. We have several tools that will assist us in this analysis. And maybe in your field, you have been using the tools. So maybe you can state one of the tools that you can remember. One of the tools that you can remember that can be used in analysis of this financial statement. So class, maybe from financial reporting knowledge, you can remind us some of the tools that we use. So class, I'm waiting for you. Yes, horizontal analysis. Joan kidogo. Ratio analysis. Yes, there we are. Replacement decision. Vertical analysis. Where? Oh. Percentage of sales. Thank you. Beverina anauliza replacement decision. Hiyo tumecomplete kwa hiyo na comparative analysis maybe. You guys know this. Replacement decision, Beverina, hiyo nayo tumemaliza. Unaona hiyo topic tumecomplete. zile video tumezipanga pale, make sure that unazipitia vizuri zote from 1 to venye zimefuatana. Hivyo ndivyo classes zimekuwa zikihappen, eh? Maybe you missed a class. Replacement, mambo ya replacements tu tumekuwa nazo na tukapatiana assignment. So make sure that you visit those video, you visit the videos, you'll be in a position to get it. So class, thank you so much for your contribution. That we are having there's several methods that will assist us in this analysis, and one of them is vertical analysis, also known as the common size analysis. We also have horizontal analysis, also known as trend analysis. It is good to know the other name because sometimes the examiner will use the other name. And we have the comparative, though in most cases we don't use that. Then we have percentage of sales method and ratio analysis. So we shall venture into those main four. So class, I think we can start having some literature here and see that we define this and say financial analysis and forecasting is a financial analysis technique. It is a financial analysis technique used to evaluate a company's performance over time. It is a financial analysis technique used to evaluate a company's performance over time. Used to evaluate a company performance over time. Used to evaluate a company's performance over time. By comparing prior period financial results. By comparing prior period. By comparing prior period before. By comparing prior period financial results with more current financial results. Voilà. No, class, you have to scrap that. Kindly scrap that. Scrap that. Sorry for that. Say that financial statement analysis. Financial statement analysis is the application of analytical tools. And techniques. Is the application of analytical tools and techniques to the general purpose of financial statement. So as to derive estimate for business analysis. I repeat. Financial statement analysis is the application of analytical tools. Is the application of analytical tools and techniques. Is the application of analytical tools and techniques to the general purpose of financial statement. So as to derive estimates for business analysis. Class, we continue and define financial planning. Sometimes examiner may ask you, what is financial planning? So financial planning involve determining. Financial planning involves determining. Financial planning involves determining the amount of capital requirement. the amount of capital requirement. The amount of capital requirement class in the coming financial period. In the coming financial period. Yes, kujipanga kujua kwamba how much shall we require, the capital, the coming financial what? A period. That is financial planning. The financial planning. Financial planning. Financial planning. Now, as we say that we have several methods of analysis or tools. Methods or tools of analysis. Or tools that we use in analysis. Tools. Analysis. So we have one, horizontal analysis. Na tumesema horizontal class is the same as trend analysis. Tuko na vertical analysis. Vertical analysis. And vertical is the same as common size analysis. Common size analysis. Then we have number 3. This is ratio analysis. Ratio analysis. And we have the percentage of sales method. Percentage of sales method. The percentage of sales method. So the 4 are the ones that we are going to look at. We're going to look at the 4. We're going to look at the 4. We are going to look at the 4 methods. We're going to look at the 4 methods and see how they are applied. See how they are applied. See how they are applied. So class, maybe we can start with the vertical analysis or common size. Vertical analysis or common size. Vertical analysis or common size method. Vertical analysis or common size method. And that one will help us to understand what is needed or what is required. What is required of us. What is required of us. So vertical analysis or common size method. You say that common size analysis evaluates. Common size analysis evaluates financial statements by expressing. Common size analysis evaluates financial statement by expressing each line item. Common size analysis analyze financial statement by expressing each line item as a percentage of base amount. By expressing each line item as a percentage of base amount. After you write the base amount, open a bracket. Open a bracket as a percentage of base amount. As a percentage of base amount. As a percentage of base amount. Put in bracket sale or revenue. You close the bracket for that year period. I'll repeat that statement because it is very important. It's very important. Common size analysis evaluates financial statement. Evaluates financial statement by expressing each line item as a percentage of base amount into bracket sale or revenue. Close the bracket for that year period. Class, hiyo ni muhimu sana. Hiyo ni muhimu sana. That means if you're dealing with the income statement and you want to analyze using this common size analysis, you're going to express all the items of income and expenses as a percentage of sale. This is what we mean. This is what we mean by that. So this is the simplest method. Simplest method hapa. The simplest method hapa is this one. Simplest method. So if I have my income statement whereby I have, this is my income statement. My income statement. So I have revenue here of 20. I have cost of sale of 5. And that will give me a gross profit of 15. Excuse me. A gross profit of 15. So if I want to analyze this using the percentage of sales method, the common size analysis, I'll express every item as a percentage of sale. This is just to mention a few. I can have admin expense or cost, maybe of 5. So this is just to mention. So this will be 20 out of 20 times 100. What will be the percentage of my sale? It will be 100%. So our sales under this method will always be 100%. Our sales under this method will always be 100%. Unlike in the other method, like the other method, you get even more than 100% and get more than 100% in a certain item. For example, the horizontal method, we're looking at the trend, can get even the trend going to a 500%. For the cost of sale will be 5 over 20 times 100. How much is the percentage? How much is the percentage of our cost of sale? 25%. 25%. So that means this would be 75% because there is a direct relationship between the three, and then this would be 25%. So we're just expressing these items as a percentage of what? As a percentage of this. So simply that is how you do that. Simply that is how you do that. Class, are we together as far as the income statement is concerned? Income statement. Income statement, the sales or revenue will be the base figure throughout kwa income statement. Nataka pia tuangalie kwa balance sheet. So I'd like us to confirm whether we are together as far as the income statement is concerned. Are we together? Are we together? Income statement. So kila wakati ukiona tu swali, you just know that you're just supposed to do that. For the balance sheet or the statement of financial position, the total asset is the base figure. Total asset is the base what? The base figure. Total asset is the base figure. Total asset. So that means we are expressing all the items of asset and liability as a percentage of what? Of the total asset. As a percentage of total asset. So you continue writing and say, oh, let me give you an illustration hapa. For example, assume I have this soft statement of financial position. Onayo, very fast land and building. The building, this is an asset of 70. I have a motor vehicle. I can say motor vehicle of 20. And then I have furniture and fitting. Furniture and fitting of this is 10. Current asset. Inventory. I have maybe inventory of 5. And then receivable of 5. So my total asset class here will be 110. 110. That is total asset. Financed by or equity and liability section. So total asset in here. Total asset Then I have equity and liability. Equity and liability. Here I just put maybe 2 items, just a simple example. Capital. Would I share capital of let me have of 100. Then I have my long-term current liability of trade payable of 10. So that's my total equity and liability. Is it divisible? Total equity and liability class ndio hapo tunapata 110. That's just a simple illustration to guide you on how now you can get these using the vertical method. So it will be given by, for example, our land and building will be 70 out of 110 times 100. So what is the percentage of our land and building? What is the percentage of our land and building? 63.63. Iko hapo juu kidogo. I have to squeeze it a bit. 63.6%. What about my motor vehicle? Let's do it very fast. Motor vehicle, it's good that we understand it from this point. 18.2. Hiyo ingine, the next one. Hiyo ingine, furniture and fitting. Ngapi? Itakuwa 10 out of 110 times that. Itakuwa kitu, sio kitu kubwa. 9.09. Tuko na ingine, inventory na receivables zitakuwa same. Zitakuwa same. Na pia okay, tofauti. 4.56%. And now class, this will be 100%. That will be 100%. And then you go to the capital. What will be the percentage of capital? The capital percentage to be somehow big. Capital hapa ilikuwa mingi. 90.9%. And then this one is 9.1. Maybe we can go with 1 decimal places. It is always advisable to go with 1 decimal places. So class, first of all, internalize that because there's nothing more that we can say as far as the common size method is concerned. So we are having a break of 5 minutes. We shall be back at exactly 6:23. So just to add, we add some notes and say that common size or this method or the analysis is done. Why is the analysis done using this method? See that it is done to help the company understand. It is done to help understand how the company has utilized income and expenses. It is done to help understand how the company has utilized its income. You wish to write all of them. How the company has utilized its income, expenses, assets, and liabilities. How the company has utilized its income, expenses, assets, and liabilities. It also helps to understand the internal makeup of the organization financials. It also helps to understand the internal makeup of the organization financials. It also helps to understand the internal makeup of the organization financials. This method is used to compare different firms in the same industry. It is used to compare different firms in the same what? In the same industry. The method is used to compare different firms in the same industry. Different firms in the same industry. Different firms in the same industry. So class, we can look at an illustration from November 2018, question number 4. Illustration from November 2018, question number 4. So let's look at an illustration. An illustration. I want you to just look at that. Just a simple one. Just a simple one. So someone to share that paper with us. Illustration, November 2018, question number. Let's just look at question number 4. November 2015, question number 4. November 2015, question number 4. November 2015, question number 4. That is the question that you can do it very fast. That is the question that you can do it very fast because it's just a simple question. Just a simple question. Just need to use the common size method to analyze the statement. So I read the question and then you do it within maybe 10 minutes, you'll be done. So the class we have the following financial statements of for ABC Limited and XYZ Limited for the year ended that is September 2018. So we have the income statement given there. We also have the statement of financial position. We are required an vertical common size statement of income for the year ended that is September 2018, 6 months, and vertical common size statement of financial position as at the same date. You said 2018, November 2018. It's 2018. The paper is in the group. The paper is in the group. Asante. Yeah. So, class, if you look at that question, it's just a direct question. Just a direct question whereby you're required to evaluate the two companies. Evaluate the two companies, the ABC Limited and also XYZ Limited. So what you do, a solution will be a direct one, whereby we are having now the vertical common size statement of financial statement of income. Vertical, you have the heading, vertical common size, vertical common size, vertical common size, statement of income, statement of income, statement of income for the year ended that is September 2018. For the year ended 30th of September 2018. 30th of September 2018. 30th of September 2018. Class, here we can have the details. The details. ABC Limited. ABC Limited. So details. We have some space here. ABC Limited. And you leave a space for the percentages here. And then XYZ Limited. Then we have the percentage of the same. Percentage of the same. ABC Limited and XYZ Limited like that. ABC Limited and XYZ Limited like that. So with that, you can have the first item, which is revenue here. It will cut across revenue, cutting across. The revenue for ABC Limited is 400,000. It's, of course, our shillings were in million. So shillings are in million. And this is a lot of money. Shillings were in million here. Shillings were in million, like that. Shillings were in million, like that. Now, our percentage of sale will be 100%. This is 4,000 divided by 4,000 times 100. And then when you come to XYZ, here we have 6,000. So this as well will be 100%. We move to the next one, which is the cost of sale. Cost of sale. So the cost of sale class, I have 3,000. So I'll be having the close profit here of 1,000. So what will be the percentage of cost of sale class? You can do it together. You can do this side together. Umalizie hii ya ABC, 75%. 75%. And automatically, this will be 25% because sales plus gross profit should add up to 100%. Then we move to expenses. We have some expenses here. And the first expense is distribution cost. Distribution cost. So for our distribution cost class, we are having 200. I just put them below here. Admin expenses to 90. Admin expenses to 90. And then we have the other one. The other one is finance cost. Finance cost 10. Finance cost is distribution cost. Of course, we are representing this, or we are expressing this as a percentage of sales. What is the proportion of the distribution cost as far as the sales are concerned? How much shall that be? Our distribution 50%. Hapana. This one. When you divide na nini? Walter divide na nini? This 200 as a percent. Always remember as a percentage of say 5%. 5%. And then we move to the next one, 290. That for 290. 290 inakuwa namna gani? 290. 7.3. 1 decimal point ni sawa. 7.3%. And then the other one for finance cost, before we move to the next one. The next one is profit after tax. Profit before tax, I think. Profit before tax. Ingine itakuwa kadogo, 0.3%. 0.3%. Then we have tax paid hapa. So this one we also need to have it percentage. You should also need to have it percentage hapa. But if this is 500, this will be 500. So what is the percentage of our profit before tax? Profit before tax percentage itakuwa ngapi? Tax paid nayo tunataka tuone kwa 380 na 120. Nipatie ya yote hii profit before tax and then our tax pia, then tupate profit after tax. Profit after tax. People are giving us the profit before tax percentage. 500 divided by 4,000 times 100. 12.5. 12.5%. And then we move to the tax. 120 divided by 4,000. Always remember to refer to the sales under vertical analysis. Tafadhali. Under vertical analysis, always remember to refer to the sales. What about hii ni 3%? Tunapatiwa 3%. Okay, 3%. And then we get the profit after tax. Hapa tutapata 380. So the percentage of profit after tax ni ngapi? Percentage of profit after tax ni ngapi? Profit after tax ni ngapi? Hapa, atia hapa. 9.5%. Class, you continue like that. 9.5%. Please continue until you finish even the XYZ limited. Please finish up. Then you do the balance sheet. itakuwa sawa. So take some